Hey, what's going on, y'all? Shout out to the LDBC. It's your boy Fight Critic here to give you guys another video. And I'm actually going to give you guys a video of a little bit of a different topic today. I know a lot of you guys have been paying attention to what's been going on with the news, with, stocks such as GameStop and AMC and other stocks like American Airlines. And there's been this massive panic attack by a lot of hedge funds. Hedge funds. So I felt it was necessary for me to put this video out because I know while a lot of the guys in the community focus on making boxing videos, or if they've got videos about things such as like dogs or like other aspects of things such as politics, I didn't see too many videos covering the financial side of what's been going on with the stock market. So I felt, I texted the brothers and I said, hey, I'm going to probably drop a finance video for y'all today, just so that this way I can provide some clarity on what's going on, just in case if anybody's a little confused by all the terminology that's being thrown out there. And I felt it was necessary to do it because I am somebody who tends to spend a lot of time focusing into the stock market. So in order for me to give you guys the ability to be okay with the things that I am saying, and at the same time also take into effect that I'm going to be very, very transparent. That's my best way for me to let you guys know that you can trust my opinion. But what I'm not going to do is I'm not going to give you advice as far as what you should do financially, because ultimately in the end, that makes me a liability for you. And that's not something I feel comfortable with. There are tons of people who get paid to do that. You can ultimately go to a financial advisor, or you can go to somebody who works at a hedge fund and you could give them your money so that they can figure out what to do. But I'm not that person, unfortunately, and I'm not going to give you that advice. The only thing that I would always advise people to do is be educated, do your homework, and ultimately, if you don't know what to do when you are becoming, a trader or an investor, because those are two different things in my opinion, then it's good to be, knowledgeable about it and believe in what you want to put your money into. That's the best, probably the only piece of advice that I can give you. But for the more experienced traders, I'm not calling myself an experienced trader because I've only been part of doing things in the stock market for roughly coming up on 5 years. So there have been people that have been in the game for 10 years and they're not even considering themselves to be experienced, or 15 or 20 years, because most really, really good and accurate stock traders spend 15 to 20 years doing this, so that this way they can build up the comfort to do it. But the stock market is a way for people to make a lot of money. And it ultimately just comes down to what kind of person you are and like what are the things that you're going to be focused into. But today I'm here to talk about what's been going on. And at the same time to let you guys know that somebody like myself, who I got into stocks in the stock market through an app like Robinhood, I'm finally liquidating whatever I had in my Robinhood account, which I considered it to be a quote unquote play account. And I'm moving it over into a much more trusted broker, TD Ameritrade's Thinkorswim app, which is something that I've been using for data over the last year. So when people talk about, what are these trading platforms, but these are brokerages. These brokerages allow you to have access to specific stocks in the market. For Robinhood, it's the most user-friendly version of trading stocks. The only problem with Robinhood is that while it's user-friendly, you miss out on 90% of the data that you would be looking for, that most of other quote-unquote stock trading gurus sell to people, and you end up paying $1,200 to learn some shit that you could just find on the internet. So when a lot of people tend to ask me about like, oh, what do you think about this guy who puts this stuff out there? I tell people all the time, 85% of the things that you're going to learn from somebody else already exist on the internet. You just got to look for the information. You can't be lazy. And I've tried specific, people putting out lists and specific lists where you pay like $20 a month and you get access to it, just to kind of see like what's the thought process to it, because I want to see what, their strategies look like. How are they able to find these? What are the triggers? What are, the things that they're looking at? And for many of these traders, they tend to use a lot of the same information. So it's a little bit of a waste of money for you to invest your time and thousands of dollars into somebody who's going to quote unquote teach you how to be an expert trader. What does make sense is buying into the access of a person who's going to give you real-time picks, entries, and exits. That's much different, because that's somebody saying, get in here, get out of there. And that's somebody who's willing to put their name on the line. But moving right along, in order for me to build the right rapport for you and to entrust that you are able to understand that I'm not trying to just talk shit out of my ass, I'm actually going to show you guys what what information that I have in terms of what my accounts look like in general. So on the top left corner, you're looking at my Betterment account, which is what I use mostly for a retirement thought process. So that account is mostly built off of index funds and Vanguard ETFs that mostly tend to do roughly around anywhere from 5 to 8%, maybe even as high as 20% year over year in terms of the ETFs that I invest in. I also keep track of these ETFs outside of Betterment because I want to see how these things perform on a normal basis. And what you're seeing in the top right and in the bottom is essentially what my Robinhood account is. Now I know you're probably asking like $500, like what the fuck is that? But as you can see underneath it, there is a plus 531.43 balance, and then there's a minus percentage next to it. And what that means is I have withdrawn the bulk load of what my account resembled, and mostly at the same time, when I look at my balance and everything like that, I had a very, very good week. I did 11% this week in this account that I was just using just to try to see if I can catch things on an upswing and so on and so forth. My more comfortable positions are in my Betterment account. I have multiple portfolios there, and most of the times I'm paying a small management fee so that Betterment can pretty much just do what it needs to do and rebalance my books if need be with the different Vanguard ETFs. But with Robinhood, I have more control over things, and I want to be able to use it. And I've grown over the year to be really, really more precise and accurate with using Thinkorswim, which is a much better platform for people who start to move past the beginning trader, point of view. For me, I just always liked Robinhood and I was always loyal to them. But after seeing what they did this week, it really, really bothered me. So in order for me to be 100%, committed to moving out of Robinhood, I yanked my account. And for what that ultimately means is that the remaining $500 that you're seeing in there is just me with a final position. I have, a couple bucks of Bitcoin, and I have a small position in a company that I think is going to pop next week. But do I feel like I'm going to probably, ultimately liquidate this account down to zero? Potentially, but maybe not. I think having $500 in there to make really, really strong, aggressive moves in the hope that you catch a GameStop or something like that would probably be something that I would be interested in. So I think having the remaining of that amount just means to me that, it's $500. It's not going to hurt my account. So why withdraw it? I'll just keep it in there and just fuck around every now and then. If I lose $500, I'm not going to be angry at myself. But let's talk about what happened this week with GameStop. And you're seeing roughly the end of its chart, and this is the daily chart on the left-hand side, and then the right side you're seeing AMC, which was also being, moving in a very similar pattern. So here's essentially what happened. And this isn't something that just happened this week. This kind of happened a couple weeks back. So a couple of weeks ago, GameStop obviously released its earnings report. So, it was actually not even a couple of weeks ago, maybe like less than a month ago. And they had, very positive ratings in terms of like how they viewed their quarterly report and their earnings, and what was the expected price per share difference. But at the same time, GameStop is working on a dying model, mostly because it's a brick and mortar store that requires you to physically purchase goods in a market where most of the stuff can be attained digitally in every way. And the only real reason why GameStop, in my opinion, I felt was able to turn in, a relative profit was because of the console launch that happened in November. You had Xbox and you had PlayStation releasing consoles. So you were able to purchase consoles through GameStop's website in order to get a PS5 or an Xbox Series X. So it would make a ton of sense why. And for AMC, I have no idea why AMC just catapulted out, upwards. I would have to just do the research to see what news came out about them, but they were moving in a relatively simple fashion. But while GameStop has a reason why it would move up, and you would have a reason for hedge funds to short it, AMC, it's very, very clear why it's being shorted this low for such a period of time. COVID has affected AMC in a way that it's made it pretty much redundant, and what it will be redundant over the next X amount of years. Mostly because with something such as AMC, nobody's going to the movies. Everybody's okay with being at home and streaming. So it makes a ton of sense why you would short it. And at the same time, whatever theaters or big production companies, they're selling the movies directly to streaming services. So unless AMC were to take on a streaming service, plan, it wouldn't make much sense to be an investor into their company. And, very similar with GameStop. GameStop is not creating a marketplace for you to digitally purchase something. Now, if GameStop moved to a digital platform where, let's say, you're able to buy things and, like, let's say they give you, like, a massive reward system where you get like 100 times the points that they fucking offer you right now for turning in a game that's brand new, then it would make quite a bit of an incentive for them to essentially switch to a digital platform. And I think that might be something that they could probably work on, especially now since they have a shit ton of cash flow. So when I look at these two companies, they became really popular mostly because of how everything kind of spanned out in terms of what they were doing and what the hedge funds were doing and what the retail traders were doing. So a hedge fund is basically a company that has individuals who do nothing but take millions and billions of dollars of lazy people who don't want to invest their own money and make them money, and they take a certain percentage off the top so that this way that they get paid. And many hedge fund managers are millionaires. Some of them are billionaires depending on how large they are. And for individuals such as Warren Buffett, Warren Buffett runs a very, very, very well-known hedge fund, or fund in a way, when you look at Berkshire Hathaway. And for Berkshire has been around for, I believe, a century at this point. But Berkshire Hathaway, if you look at what their fund price is in terms of like what their stock trades at, it's in the hundreds of thousands range, because a lot of people like Berkshire. A lot of people invest into Berkshire no matter what the amount is. And if you look at why it's that expensive, is because it's setting the bar for what type of money you need to make money off of them. So that's why Warren Buffett has been able to be a top 5 most wealthiest person in the United States and a top 10 worldwide in terms of the most wealthiest people in the world. But you also have hedge funds that not a lot of people know about, but they make billions of dollars. And one of the very, very common ones, especially here in New York, is Citadel. So Citadel is a hedge fund, but also Citadel is a hedge fund ran by the richest baseball owner currently, Steve Cohen, who is the owner of my beloved New York Mets. But Citadel is also a huge investor into Robinhood, and they have a ton of capital that's invested into them, because Robinhood essentially executes a trade whenever you buy it, and they sell the data to Citadel, so that Citadel gets an idea of where the market is moving, so that their hedge fund managers can move in the same direction or move against it if they can find an opportunity to leverage more money against it. So with Citadel being a hedge fund, and you now look at Melvin Capital, which was losing billions of dollars based off of what happened, Citadel pumped essentially $2.5 billion into Melvin Capital. So with Melvin Capital going through getting an influx of cash because it was losing money off of these moves, you now have to look at things such as, they kind of fucked up. And you kind of have to look at why they fucked up. So when you look at these two charts, you don't have to pay much attention to the candlesticks, but you have to pay attention to the gap up. And on the left-hand side, you can see that GameStop went from anywhere being a $4 stock to an $18 stock to now it's even approaching levels of close to $500. And for AMC, a stock that was virtually a dollar or pennies, at some point, is now close to approaching $20 a share. So what happened here, and how did we get to this point of it happening? So there's a couple of key terms that you have to realize. So I want you to pay attention to this here where it says shares outstanding. So you see where it says shares outstanding. So when you look at shares outstanding, that means the amount of shares that exist in terms of the company in general. So GameStop has 65 million shares available for people to invest into its company, meaning that one share is equivalent to whatever the dollar price is. And right now, that dollar price right now would be seen at $325. So you do the math of 325 times 65.20 million. And the same and vice versa with AMC, which is sitting at $13.26, and they have 107.7 million shares that are outstanding. But there are two key factors underneath these charts. One is the shares float, and the other is the short float. So the share float is essentially how many of these shares are publicly available. So the shares outstanding is the total shares that are available, and then the shares that are float are the shares that a part of that entire bunch that are available for regular everyday people like me and you, and as well as hedge funds. The reason why that number is lower than the shares outstanding is, much like with any company, you have executives who have shares in their company. So the difference of math between those two, that number that you're not seeing is basically shares that are inside the company. So when they call things such as like insider activity and X, Y, and Z, that is basically the executives in those positions who are essentially trading their shares amongst the themselves. They're buying, they're selling their positions to different people inside of their own company. Companies like Apple are very, very common for doing this method with their employees, where when you become an employee, you get a restricted stock, or what's called an RSU, and that is a stock that takes years to vest, sometimes maybe 3 to 5 years, depending on how valuable the share is. But they don't count it against the public shares that are being floated, because it's a share that can't be bought or sold at this time. And then you've got a ton of individuals who are on very similar programs. Every single employee is, in fact. But when you look at the shares float, that's what's available to everyday people to use apps like Robinhood and Thinkorswim, or Charles Schwab and X, Y, and Z. So when you look now at the shares that are float in terms of the percentage, that percentage is the amount of shares that are essentially pulled from the float that people have taken negative positions on. So this is what you call a short. And the big reason why you are looking for this type of information is, if you have noticed that a certain stock is being traded where a short percentage is either in the range of 15 to 20% or higher, then that lets you know that there are more people controlling the negative push down of the stock, as opposed to people who are investing with the stock moving up. Now, how do you short a stock? Well, you short a stock by borrowing the share. You don't pay for it, you borrow it. So you borrow it with a contract that has an expiration date. So what that means is that, let's say that I was one of these hedge funds with GameStop, and I know GameStop's business plan is becoming obsolete. Their stores are probably going to be obsolete in time. So I go to my broker and I see GameStop at $10 a share, and I think it's going to go way down because they just have an obsolete business model. I go to my broker and I say, hey, do you have any shares of GameStop right now in which I can take a short position? And my broker can say, yeah, you know what? I have one contract for one share that you can borrow, as long as you buy it back and you return the share to me by the time that the contract expires. So you're basically making a legal binding agreement to return the share when the contract expires, as long as you will buy the stock back at a point where you feel comfortable in paying it back. So if I borrow that one share at $10 and I drive the price down to $1, I can essentially buy the share back at $1 and return it back to the broker, and I have made $9 off of the share. That is the simplest way I can do it. But there is also the negative side of it. And the problem with it is that the negative side of it, while you can make money going down, you are capped at a specific amount of money that you can make going down. However, if the market goes against you, and let's say more buyers come into the market and they start to outperform the short position, then my loss can be infinite. If that $10 contract that I borrowed in order to short the stock, and I am promising to buy it back at a lower price, now sees it exceed to $20 and $30 and $40 and $50 and $100, I have to at some point buy that contract back at a much higher price and lose money in order to do it. Catch my drift? So that's essentially what these hedge funds were doing with GameStop. They saw an opportunity to short. Now, shorting is not something that should be looked at in spite. Shorting is just a trade strategy. There are plenty of people who are going to short GameStop the minute that their volatility settles. And volatility is based essentially on how rapid is the price going to move based on how many shares are available. And the same reason why they're looking at the volume to settle. Volume is the amount of transactions that are taking place between buyers and sellers in the market. So when you look at those two things, shorting is not something that is, considered to be a cardinal sin. It's a trading strategy. It's a strategy that certain people put their portfolios based on. They see something that's overvalued and they feel like it shouldn't be this high, so they take a short position and they just look to try to get out at a specific dollar amount in order so that they can make money. They return the share back to the broker. But you can get infinitely burned here, and that's what happened to the hedge funds. Because what a lot of researchers looked at when it came to WallStreetBets, a very popular Reddit forum, is they saw that the amount of shares that were available, which is the 50.65 million, that 121% of it was being shorted. That means that of the available shares, there were more shares being shorted that was available. So you know what that means? That means that whoever had shares in the company that was losing money and decided to sell it was essentially being bought by other individuals who saw this and said, hey, these guys kind of fucked themselves over by shorting more than the available shares. That means that if we are able to outbuy them at a specific amount in terms of the total amount of shares that we just keep buying from each other, we can make the stock go up. And that is what happened. Now you had people who were buying shares from other individuals who were at 5. Then they were buying shares from people who were at 10. Buying shares that people were at 20, 30, 50, 100, 120, 300, 400. And people just kept buying and selling shares, buying and selling shares because there was nothing available for people to just buy. You had to get it from somebody who was selling. And for the shorts, you got fucked because you got in at that $20 margin and now you are stuck holding or having to buy that back at a much higher value. And the reason why you have to buy it at a much higher value, because the brokerage needs that share back. They need it back because people are buying shares and they want to make money. And if you are not able to do it, and if it expires, you have no choice but to return it back. So that is why you saw people like Melvin Capital who lost $13 billion on this short position because they got way too aggressive. And you're seeing people lose money with AMC because they're taking a short position that is just not in their favor right now because the amount of shares that are floating and the percentage of shares that are being shorted is too high. It's already high if you are approaching over 20% of it. Imagine looking at levels at 120 where the stock just goes parabolic. And rather than people just say, hey, that's just the nature of the beast. That's the nature of the game. No, what you saw is you saw a bunch of rich white hedge fund managers get on very popular news channels and start to bitch and moan about retail traders. And the sad part about it is, if you were to look at the idea of what they're doing, they're not mad that they all got together and decided to short the stock, which is clear manipulation. They instead want to call manipulation based on the retail traders that banded together and said, hey, let's just all buy this because they shorted too much of it. No, that's just you getting caught and you fucked up. And you're trying your best to lie your way so that this way you can somehow get a bailout. Or you can get people to start selling their shares so that you can try to cover your position on the way back down. So that is why you're seeing Citadel, who is an investor in Robinhood, float $2.85 billion to Melvin Capital so that they don't go under. And that's why you're seeing very popular stocks right now like BlackBerry, in which Robinhood, and this is the core reason why I'm leaving Robinhood, is Robinhood decided to limit or eliminate trading on these stocks. And that is a huge problem. Why? Because you have built your model essentially as a brokerage where you are giving access to regular everyday people to purchase stocks. And when you take the aggressive advantage of essentially siding with the billionaire hedge funds, your business model and your mission of trying to get everybody, who doesn't have billions of dollars to get in the stock market, you're effectively telling them to go fuck themselves. So that is the core reason why I'm getting rid of Robinhood. I had no problem before with Robinhood selling the trade data to other hedge funds because at the end of the day, they have to make money somehow. But when you tell me as a consumer that I can't purchase GameStop at $400 because you want to tell me that, oh, it's risky and you want to protect me from what? What if I don't care if it goes down? That is my decision to make. But when you limit the amount of people who want to continue to buy the share, you're effectively killing the volume, you're killing the volatility, and you're allowing the stock to go back down. And when your stock goes back down, you are allowing these hedge funds to win. You are allowing them to make their money back, and you're allowing them to get away scot-free. Because you know who doesn't get scot-free away? The people who got in at the top, who you're fucking over. So that is ultimately one of the big reasons why I've decided as of yesterday to close out just about all my positions and to move my portfolio that I use just to kind of, play around and just continue my strategies into Thinkorswim. If you are somebody who is interested into more financial videos like this, where you want to get my point of view on something, as long as I'm not telling you what to buy or sell, I'm perfectly fine making more videos like this. But what you need to realize, especially in the stock market, is the stock market is rigged, and it's rigged for the guys who've made billions of dollars for decades in the game, for them to continue to do it. And one of the big reasons that a lot of people tend to now start to open their minds and start to realize that, yeah, this is fucked. This is not a free market. And I could have told you that years ago. There's a big reason why Black Wall Street isn't around. Why? Because black people would have been doing the same things in order to increase the livelihood of their lives that a lot of hedge funds do. And white people just weren't happy with that. So they burnt everything to the ground. But for me, this is not going to deter me away from trading. This is not going to deter me away from looking at the stock market as a way for me to make additional income. And ultimately, at the end of the day, I care about my future. I care about being able to have a sustainable amount of money so that by the time that I get to retire, whether it is I get to retire young or get to retire old, I have money in place. I have money in place for my future kids. I have money in place for my niece. These are the things that I care about, which is why I look at the stock market as a way to figure out, what can I jump into? What can I, keep as a long-term investment? But for hedge funds, their goal is to manipulate the market so that they can make billions of dollars at the expense of other individuals who lose money. Because the thing about a trade, somebody wins and somebody loses. There's never a trade where both sides come out on top. Let's just be honest about it. And that's the way that the stock market works. For hedge funds, they spend billions of dollars trying to influence the market in their ways so that they can always make money. It's much different from, back in 2008 where Exxon was not Exxon, but Enron was essentially a scam, and they didn't deserve to exist. And a very, very, very famous venture capitalist, Chamath, who went on CNBC, he was backing the retail traders, even though he owns, a venture capitalist firm that invests into companies and invest into the stock market. And he was saying these hedge funds deserve to lose for being super aggressive. And I've been a little bit of a fan of his ever since he told the airline industry back in the beginning of the pandemic that they deserve to go under if they couldn't survive COVID, because all of their executives took high salaries, took high bonuses, took high stock positions, while their employees don't get paid enough. And you know what? He was absolutely right. He was right then, and he's right now when it comes to the hedge funds. So for them, it's good luck. I don't see GameStop or AMC slowing down. I don't. Because at this point, it's not about people who want to make money. It's about proving a point. And if millions of people want to see hedge funds burn to the ground, this is what they're going to do. So for the hedge funds, don't get caught trying to do something and manipulate the market, because sometimes it comes back on you. And you guys lost billions of dollars this week. So that's ultimately my thoughts on the matter. Once again, I'm not telling you to go out and buy a stock or buy any crypto, but, just do your research. Do your research, do your due diligence. And, at the end of the day, if you're really good at it and if you continue to be good at it, you can make a shit ton of money.